Hey folks, welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This video for Thursday, February 2nd, 2012 is sponsored by Realtik. Alright, markets today floating around the flat line. You have the Dow down 8 points, NASDAQ up 10 points, S&P 500 up about 2 points on the day. And you can see, again, it was another choppy-ish type day, just like yesterday. Yesterday we opened, if I just zoom out a little bit, up on the day, went higher, and then pulled back. Today we opened flat on the day, went higher, pulled back, went negative, and have now moved back up. So again, you can see it's a very choppy type day, which is much like the markets have been recently. Now, again, let me just talk a little bit about the key levels here. I want to make sure everyone fully understands what's going on, what you need to look for. Now, again, last Thursday, 1 week ago, we hit the master 133.30 level. I've talked about this level for months previous to it actually getting tagged. I said this was the level it was going to hit, and this is the exact level we did hit. Off of this level, you saw a beautiful little sell-off, and now we've floated inside of that level. And what we have to watch for here is the fact that as long as we do not close above this 133.30 level on the SPY, the markets technically should and could see a pullback. All right, now again, the light volume in the market's making it very, very tricky for that to happen. But at the same time, you have to say to yourself, listen, the level is still the level. It hasn't changed. Therefore, again, if you're below it, you have a slight negative bias. If you are above it on a closing basis, then you have a slight positive bias. That's simple, folks. Imagine a cliff. You're either on the cliff or you're over the cliff, one or the other. All right, so again, regardless of all this nonsense, yesterday's little update, today's choppy action where we're on the flat line, doesn't matter to me because you know the level that you have to follow, and that's all that matters, okay? Now, again, a couple other things to watch here as we enter the afternoon or the late afternoon session on the markets. I want to go to the daily chart, and again on the daily chart, I keep on showing this to you guys, but I think it's unbelievably important. This is where you get the 133.30 level on the spiders. It's a gap fill right here going back to July 26th. In addition, what's even more important is if you zoom out on the charts to the highs of 2007, take that high pivot connected to the high of 2011, and you get that same exact level. So again, bottom line is that's the level you're watching. And again, whether or not the markets get through it, who knows? But again, as long as you're below it, little negative bias. If you're above it, positive bias. That's simple. Okay, if you continue up past that level, 133.30 level, then you're going to head towards the 134.60 to 135.50-ish range, which again is this pivot top and this pivot top. Right in that area is the next level that you would get to. And again, as long as we're below, I keep a neutral to negative bias on the market, expecting a small pullback at any point. And again, could that happen tomorrow with the jobs data? We have the non-farm payrolls data tomorrow, unemployment rate. It's possible. Who knows? We'll wait and find out and just trade it according to what we see on the charts. And that's what we do here at InTheMoneyStocks.com, folks. I don't care. I'm not a bull. I'm not a bear. I trade what's given to me. I trade what the charts tell me. That's it. And that's how we've been successfully profitable, making more money than any hedge fund out there, more money than any institution out there in terms of percentage return for the last 4 to 5 years since this company has been in existence. So again, if you want to come and step up your game, come take the 7-day free trial to the Research Center, 7-day free trial to the Intraday Stock Chat at InTheMoneyStocks.com. All right, now let's take a look at a couple other things here I want to show you guys. First off, if we go to the dollar chart, I did find the dollar action yesterday to be extremely intriguing. The one thing you just want to pay attention to is look at this topping tail going back to kind of mid-January and look at the fall that we got. So we got a beautiful fall on the dollar off of a topping tail. Topping tails are bearish, obviously. Now, as the market has fallen down here, you could make a case that yesterday you got a little bit of a bottoming tail. And sure enough, look at the dollar. It's trying to make its way up. Now, if the dollar starts to head north, this market should pull back. So again, we've seen the market go up pretty substantially in January. Well, guess why? Because the market was falling, or the dollar was falling. Markets go in the opposite direction. They're inverse to the dollar. If this is a bottoming signal on the dollar, and the dollar start to bounce higher into this range right here, in theory, the market should pull back. So again, it kind of gives you a coinciding factor aside from the spider's analysis that we still could see a little bit of downside in the market in the recent or in the not too distant future. Okay. Now again, let's go to the gold chart. Gold's a big one here, guys. I actually myself scalped gold on the short side today beautifully for a nice profit. But the reason why gold's important is you have to look at this pivot high right here, 170.75. Draw that line right across and look at exactly where we're trading. In addition, you have a little pivot right here, which is a gap fill. And if we take that area and just draw it across, you can see you got right into that area. There's a lot of resistance on the GLD here. And my analysis is showing that we're due for a pullback in gold, and you actually could see a pretty successful pullback down to minimally this level right here, which is a key gap fill at the 166.60, 166.50 level. All right, that would be about a $4 or $5 pullback on the GLD from these current levels. All right, and again, it's all about the resistance levels. Pivot high, gap fill right there, where we basically did both of those today. And then also you have to recognize the resistance based on the extension move. Look at how far extended gold is short term. It's definitely due for a pullback. I like it as a pullback candidate, and I do think it will pull back in probably the next week or so. You'll see a pretty solid pullback to this level right here. That should coincide with the down market as well, by the way. Gold and the markets tend to go together because as gold is going up, what do we know about the dollar? The dollar's going up, down. If the dollar's going down and gold's going up, what are the markets doing? Markets go inverse to the dollar. Therefore, if the dollar's going down, markets are floating, markets are floating up, as is gold. So they actually go together. Gold and the markets go together. It didn't always used to be that way. It used to be, well, when the markets people got panicked about the markets, they would run into gold. But not that way right now in this type of market. Okay? SLV, quickly, let's take a look at the SLV. Continues to kind of grind higher. I would say on the SLV, if you want to really take a short on this, based on the charts that I'm seeing here, you might as well give it some space. See if it can get up here. If you get up here, this is a great level. 200 moving average on the SLV and a pivot high. That makes sense, you know? Just thinking about it logically makes total sense that would be a great level because you have two specific resistance areas in that area. All right, USO continues to fall here. Beautiful fall. I've been having a negative bias on oil for the last couple weeks. The reason being is simple, and I'm going to explain it right now for those of you that want to learn. First, the biggest thing you had to do is recognize this trend line, which I gave out to members long ago. And this trend line right here was everything you needed to know and the reason why you could have a negative bias on oil. Let me explain. You can see we're under here, right? So you came up to that level, pulled back, came up to that level, pulled back, and then you broke out above this range. So this was a breakout. Now a breakout, as you can see, it kind of chopped around here, hit the level, and then it failed. A failed breakout is pretty significant. It does right there tell us we should see some more downside. But the key was the failed breakout then went back to this blue line. It gapped above, closed below. Gapped above here, closed below. Gapped above, closed below. It could never recapture that line. As long as you trade on the lower end of this, meaning below this line, you should just naturally have a negative bias until you hit first and second targets. If you had gotten above and closed above, then you'd have a positive bias on it. But again, notice how you got above on an open, but you never closed above. Each day these candles are closing below the blue line. Therefore, you must keep a negative bias on it. It's showing you weakness. And again, my first target was the 200 moving average. Obviously, today that's been achieved. Second target is right here, which I would not be surprised if that's achieved as well. So again, good call there on the oil trade. Now, just looking at a couple other things, folks, let me just go into a couple other charts here. Let's take a look at JP Morgan. JP Morgan just up 17 cents. Stock is extended, but as I said in yesterday's free video to you guys, there's really no reason to be shorting JPM. There's better charts to short right now if you wanted to short it. Yes, it's extended, but there's so much support there. You have the 200 and the 20 moving average connecting. The chart I like personally is Goldman Sachs. Goldman Sachs yesterday went to my exact level. Ever since then, it's been a great short. And again, just simply take this pivot high right here, draw it across, and you have that pivot high and the 200 together, and since then you can see already a pullback from that level yesterday. All right, looking at a chart such as ExxonMobil, Exxon still continuing down after some not so good earnings, I believe Monday morning, and the target here, folks, is pretty simple. Right there, the 50 moving average should be some support. Would I buy it there? Considering I still am slightly negative on the markets, as long as we stay below that level, I think I'll stay back and not pick it up at that point, but I do expect a decent chance of a bounce there. Apple Computer. Even with the tech sector up about 10 points, the NASDAQ's up 10 points, the Apple Computer stock here, or Apple Inc., is down slightly on the day. And the reason is, again, it's just so extended. Remember, the aftermarket highs were right around that 460 level, and that's after earnings. It got about that high. So you can see the high was just up underneath that level. It just got a lot of resistance. The stock, again, has had such a trek higher, amazing move higher. And again, it just doesn't have the buyers there anymore to pick it up. So in that sense, again, stay back on it. I don't know if I'd short it because, again, it's the strongest of the strong. The best earnings of the season were from Apple, so I don't think it's a short. But at the same time, definitely not being picked up as a long by me. There's no way in heck I would do that. All right. Amazon, after some not so good earnings yesterday. Now, this is interesting, folks, because Amazon, again, gapped sharply lower and actually recovered decently. And then today it started to go down again and then recovered and is now positive on the day. I would not be buying this. I would not be shorting it. All right, it's a neutral play. There's no good price pattern and time factors there. It's a stay on the sidelines type thing. If Amazon went up to gap fill all the way up here, yeah, I'd short it. If Amazon went down, probably down on the daily chart to this pivot low, would I buy it? Yeah, I'd probably give it a little bit of a swing trade buy. But as you can see, there's no level there to be had. You're not down here at the blue line, and you're not to gap fill up here or the 200 moving average up here to short. And again, this is where you become the best trader you can be, where you become profitable, where you make millions and millions of dollars in trading, is by having an eye for this. And it takes a little time, but I'm here to teach you the proprietary techniques. And I'll tell you, there's river theories, there's three-tail theories, there's confirmation signal. These are all proprietary techniques that will ultimately make you a good trader, a profitable trader, and make you money in the future. The key is, again, do you step up to the plate and take the 7-day free trial to the research center or to the intraday stock chat here at InTheMoneyStocks.com. So again, we encourage you to come check us out. 7-day free trial, no obligation. As long as you cancel before the end, there's no charge whatsoever. You can cancel at any point. You have access for your full 7 days. It's an easy thing to do. It's free. It's profitable. Bottom line is most people come here, take the 7-day free trials of the research center, end up making enough to pay for multiple years of that research center just in that free trial period. All right, guys, have a great afternoon, great evening. I've got to get back to trading and make some more money this afternoon. Take care.